Have you ever wondered how the world's best investors think? What separates a smart investor from a foolish one? Today, we're diving into The Intelligent Investor by Benjamin Graham, the timeless Bible of investing that Warren Buffett himself calls by far the best book on investing ever written. What is The Intelligent Investor about? First published in 1949, The Intelligent Investor is not a get-rich-quick manual. Instead, it teaches you how to invest safely and wisely over the long term. Benjamin Graham, known as the father of value investing, lays out fundamental principles to help individuals protect their money, grow it steadily, and avoid common investing mistakes. This book isn't about how to beat the market. It's about how to avoid being beaten by it. Key concepts and takeaways. 1. Investing versus speculating. Graham draws a sharp line between investors and speculators. Investors make decisions based on thorough analysis, aim for long-term results, and prioritize safety of capital. Speculators chase trends, follow tips, and often gamble on short-term price movements. If you don't know whether you're investing or speculating, you're probably speculating. 2. The concept of Mr. Market. One of the most famous metaphors in the book is Mr. Market. Imagine the stock market as a business partner named Mr. Market. Every day, he comes to you with a price at which he's willing to buy your shares or sell his. Some days he's euphoric and offers high prices. Other days he's depressed and offers bargains. The intelligent investor doesn't get emotional or follow the crowd. Instead, they use Mr. Market's mood swings to their advantage, buying when prices are irrationally low and selling when prices are irrationally high. 3. The margin of safety. This is Graham's core principle: always invest with a margin of safety. That means buying assets when they are significantly undervalued compared to their intrinsic worth. Just like engineers build bridges that can hold more than the expected weight, investors should buy stocks with a cushion, so even if things go wrong, you don't lose everything. 4. Defensive versus enterprising investors. Graham identifies two types of intelligent investors: the defensive, passive investor wants safety and simplicity. They don't want to analyze stocks constantly. Ideal approach: invest in low-cost index funds, diversified portfolios, and focus on long-term consistency. The enterprising, active investor is willing to spend time researching and analyzing individual stocks. Ideal approach: search for undervalued companies, use fundamental analysis, and take advantage of market inefficiencies. But Graham warns, most people think they're enterprising investors, until the market humbles them. 5. Value investing. At the heart of Graham's philosophy is value investing, buying stocks for less than their intrinsic value. This means looking at a company's earnings, assets, dividends, financial health, competitive position. The goal is to find solid companies that the market has mispriced due to fear, panic, or short-term problems, and invest in them patiently. 6. The importance of temperament. Being intelligent isn't enough. Graham emphasizes the importance of emotional discipline. To succeed, an investor needs patience, discipline, the ability to ignore market noise, resilience in the face of downturns. Smart investing is more about character than IQ. 7. Stock selection. For the defensive investor, Graham suggests the following criteria for conservative stock picking: adequate size of the company, strong financial condition, consistent dividend payments over many years, moderate price-to-earnings ratio, PE, moderate price-to-book ratio. He advocates for diversification, not putting all your eggs in one basket. 8. Bond allocation and inflation. Graham stresses the need to balance stocks with high-grade bonds. He recommends adjusting the ratio of stocks to bonds depending on market conditions and your personal risk tolerance. But beware of inflation. He explains how inflation eats away at the value of your money and why stocks can be a better long-term hedge against inflation than bonds. 9. Beware of market predictions and financial gurus. Graham warns against relying on market forecasts, tips, or Wall Street analysts. The future is uncertain, and no one, no matter how confident, can consistently predict the market. Instead, focus on what you can control: your analysis, discipline, and behavior. Graham's legacy. The Intelligent Investor isn't just a book, it's a mindset. Warren Buffett, one of Graham's most famous students, credits this book with shaping his entire investment philosophy. He even said, "Chapters 8 and 20 of this book have been the bedrock of my investing activities for more than 60 years. Chapter 8 talks about market fluctuations and how to deal with them. Chapter 20 discusses the margin of safety in more detail. Final thoughts: the intelligent investor thinks long-term, stays rational when others panic, buys with a margin of safety, avoids market noise and hype, doesn't try to time the market, builds wealth steadily, not quickly. Graham doesn't promise big rewards overnight, but if you follow his timeless principles, you'll have a solid foundation for growing your wealth and keeping it. That's a wrap on The Intelligent Investor by Benjamin Graham. If you found this summary helpful, give the video a thumbs up, subscribe for more book breakdowns, and comment below, what's your biggest takeaway from Graham's philosophy? Thanks for watching, and remember, be wise, stay calm, and invest intelligently.